Good evening, YouTube. Welcome back to a special edition of Driving Up Stocks. In the past, I have talked about some different videos that we were going to do outside of our Robinhood portfolio challenges. So this is going to be one of those. We've talked about the long-awaited dividend video. This is not it. I'm sorry. And then a couple others. I'm lost my train of thought there. But yesterday I was involved in a discussion on ETFs, specifically closed-ended funds. Apparently there's a lot of confusion out there about what is an ETF, what kinds are there, what do they do, what's the purpose and all that. So I just wanted to take a few minutes. I was actually going to put this in yesterday's video. That was at episode 27. But as I mentioned in that video, I had a lot of information that I was trying to pack in a short amount of time, so I didn't want to really drag that video out a long time. So today we're going to talk about some ETFs. Stay tuned. At the end, I do have a special announcement, a teaser for a special announcement. I'll give a little bit of info here today. Probably by the time I do my episode 28 Robinhood portfolio update, I'll have full details for it. But moving on, what is an ETF? ETF, not WTF. Come on, people. I'm more boomer than millennial, so. That's not my hip slang. No, ETF, which is an exchange-traded fund. I promise that's the worst joke I'll make in this. Exchange-traded funds, ETFs. They are very similar to a REIT, which we've talked quite a bit about REITs on this channel, where a REIT deals in real estate. So if you ever wanted to invest in real estate, didn't have the enough funds for it, you could get involved in a REIT. What they do is, depending on the type of REIT, they would go out and they would buy, let's say, a mini mall or several mini malls, or they might have condos across the country, or they might have multifamily apartments, or multi-unit apartments, or single-family homes that they rent out. So this is your chance to own real estate without having thousands upon thousands of dollars to own the whole thing. You can get it a little chunk at a time. ETFs are similar. What an ETF is, instead of investing in real estate, you're going out and getting into a specific industry, or let's say you were always interested in the the top earners in the Dow, and let's say you wanted to invest in Apple, you wanted to invest in Amazon, you wanted to invest in Microsoft and McDonald's. I mean, that's four stocks there that are going to put you, close to $3,000-$4,000 to buy one share of each of those. And if you have a small account like I do and many of my viewers do, that's the whole purpose of this, is starting very small and building up to those larger accounts, which is our, of course, end game goal. You obviously don't have $3 or $4 grand sitting around to buy one share of each of these stocks. And if anything would happen with those stocks, that's going to really kill your portfolio. So what an ETF does is they'll say, hey, we're going to go out and we're going to invest in the top 10 companies in the Dow, or the top 10 companies in the S&P 500. Or if you wanted to invest in oil, hey, we have these 10 really popular oil stocks that we'll pool our money into. And they are basically, in essence, I'm trying to speak in as simple terms as possible in these, they are basically they are limitless. As long as there's money coming in, people are buying more shares. There's the cash flows coming in. They're going to continue to grow. They're going to continue to buy more shares of these different stocks, or increase their position in them. So it's a win-win for you. Typically, much like REITs, ETFs come with a higher dividend yield. They are dividend stocks. Again, you still want to watch out, because we've said in the past, a lot of the experts say you don't want to go over a 7% dividend, because it's not something that's easily maintainable over the long term. whereas a 3 or 4% interest dividend payout, that can be done almost infinitely as long as the company's making money or has money coming in. So some of these ETFs will go up as high as like in the 20%, and that's, I don't want to say it's impossible to maintain, but it's going to be extremely difficult. So you still want to look around that 10, you don't want to go over 10-12% there. That one I'd give you a little bit more leeway, because when we get into closed-ended stocks, that'll be kind of important. So that's basically an ETF in a nutshell. Is you're getting a group of stocks, or you're being able to invest in a diverse amount of stocks in a certain industry that you might have been interested in, or it might just be a really popular ETF. And again, the subject that stirred up the subject matter for this video was kind of a trying to think of if that was a Facebook group. Yeah, it was a Facebook group that I'm in. It's mostly Robinhood traders, but there are also some people in there from Webull and whatnot. But there was discussion on closed-ended ETFs and what the difference was. And I've never really looked into ETFs enough to know that there was a difference between, your regular ETF and a closed-ended. So I started doing a little bit more research on it and found out your closed-endeds, which I actually have a share of a closed-ended fund, typically have a fee attached to them, and they are more like regular stocks. So in regular stock trading, you can, let's say Coca-Cola has 500 million shares, open shares. So that's it. If 500 million shares is what Coca-Cola issued, and 500 million shares have been purchased in whatever way, shape, or form, that's all there is, unless there's another offering. That's similar to how closed-ended funds work, is there's a finite amount of shares you can buy. Whereas your normal ETFs, as I mentioned, are almost infinite, and as long as there's more money coming in and they want to expand, there's no limit. Basically, if they have 500 million people that want 20 shares, 500 million people can have 20 shares, more or less. So again, I'm making this in simple terms, so if I get any details wrong, feel free to flame me in the comment section. I'm kidding, don't do that. Make sure, even if you hate it, hit that like button for me. Make sure you subscribe. I appreciate it. Oh no. But yeah, the closed-ended funds, there's a finite amount. So if they only issued 100 million shares, that's all that's available out there. So if 100 million have been bought and you want in, you're going to have to hope that someone who holds them wants to sell. Otherwise, you're out of luck. The other thing you can get into with a closed-ended fund is, let's say the stocks in that portfolio are worth, are given a value of $100. And everyone's really excited about it. They go in and it drives the price up to $115. So now that's trading at, I think they call that trading at a premium, if I'm not mistaken. But the stock price is more than the value of the stocks. That's where things can get dangerous. Conversely, if there's $100 worth of shares, or that share is valued at $100 based on the companies in it, and people are like, I don't really want this, I'm not interested, it's not very popular, or it's new and it didn't have the hype, and it's only trading for around $80 a share, you're getting that at a discount then at that point. So then that's where you're really getting your money's worth. So look out for that kind of stuff. Make sure you do your research on those ETFs, especially the closed-ended ETFs. Make sure you know what you're getting into. Look at the companies they're investing in. That'll help keep you out of trouble. And I also mentioned there's a fee. The closed-ended funds have a fee. Typically, you're looking at around 1 to 2% charged annually to be part of that closed-ended fund. And that's why they many times will have a little bit higher dividend payout, kind of offsets that, so that kind of helps. Watch out for that, because there are fees that can be attached to those closed-ended funds. So, anybody has any questions on those, please feel free to ask me. Hit me up in the comments. I always respond back to all our comments that are down there. Again, make sure you like this video. If you hated it, dislike it, but please leave me a comment. Let me know why. Let me know what we can do to improve. Now, my special teaser. Big thank you to Anthony. We've given them a shout out over at Malone Money Mindset. He was a guest on a show recently, and he has kind of helped get me in touch with Rick that runs the channel, and I have been asked to be a guest on this live stream Q&A. So again, I said this would be a teaser. I will have more details coming out. Still working on everything. I do have a date, but we're getting everything confirmed right now. As soon as I get that done, as I said, by the time my next video rolls out, probably around Monday, everything will be, all the details will be hammered out, but that's big for us. So I thank you all for your support, for your help. If it wasn't for you all, I've said it many times, I never imagined I'd even get 10 subscribers, and now we're up to almost 30, and hopefully we just keep going from there. So thank you, bottom of my heart, everyone, bottom of my heart, thank you so much for your support, for all your likes and everything in the comments, and anybody that reshares these videos, thank you. Please make sure you are leaving comments down there. Get a hold of me, let me know what you want to see, done differently. But thank you all for making Driving Up Stocks what it is and what it can be, and what we hope it can be as we grow and we get better equipment and do better things. So I look forward to seeing you all on the next video. Again, big thank you to our friends Anthony over at Malone Money Mindset for helping us with this big opportunity to really, wow, I'm really at a loss for words. I mean, I'm just so thankful. I never thought I'd get an opportunity like this. So thank you again, Anthony. Very much appreciated, my friend. So getting me in touch with Rick over there so we can make this happen. But until next time, everyone, thank you. Let me know if you like this kind of video. I'd like to do a lot more of these, and hopefully in a better setting. But of course, we want to keep up our Driving Up Stocks theme. So take care, everyone. I hope you all have a great weekend. Until next time, see ya.